Good afternoon. Welcome to the monthly market outlook call for March 23. If we look at global economy, there is a mixed forecast for 2023. US Fed is still raising interest rates. Supply side pressures have eased down, but inflation remains elevated. China continues to puzzle with a very fast opening of economy post-COVID. Overall, experts are divided about how 2023 will shape. If we look at the headline, well, global headlines are full of negative news. A prestigious newspaper like Wall Street had an article which said, to save money, you should think of skipping breakfast. In UK, essentials like tomatoes and other items are on a ration basis. In China, top tech billionaire went missing and the share prices plummeted. Dr. Mark Mobius, famous emerging market investor, made a comment that I'm unable to get money out of China. So clearly global headlines are blend of negative and some positive. If we look at central bankers' action to control inflation in last almost 2 years, they all have raised interest rates quite dramatically. But when it comes to taking out liquidity, they have taken out very small quantum. Between subprime crisis to now, they added $11 trillion of liquidity. But when it came to taking that out, they have only taken out 2.8 trillion. By raising rates and not taking away liquidity, can inflation come down? Well, time will tell. Commodity prices have corrected from oil to other commodities, yet inflation remains reasonably elevated. It did correct in US, but in UK, in Eurozone, inflation continues to remain elevated. And even in mighty US, the inflation target is about 2%, whereas the actual inflation is upwards of 6%. IMF, however, has upgraded global growth forecast. Yes, global growth has slowed down, but now it seems to be bottoming out in US, in Europe area, in emerging market, and including in China. So at least growth outlook seems to be turning better from the bottom. This growth is visible in manufacturing momentum, where India and Thailand appears to be the expansionary mode. Services expansion is all over the world. Hotel, aviation, tourism, travel, IT services, those kind of services are leading expansion of global growth. Despite improvement in growth outlook, consumer confidence across the world continues to remain shaky, continues to remain weak. Higher inflation, uncertainty about the future, it is impacting consumer confidence. China went through a COVID phase like India went through in 2021. And now, as China is back to operating at full capacity, there is fear that inflation across the world may end up getting on the higher side. The problem for China is the real estate and debt. A large part of their growth, especially post-2008 crisis, came from real estate sector. And real estate sector was funded, leveraged out of domestic debt. Now they have built many houses and cities for which there are no takers. How does China resolve their real estate problem continues to be of interest to everyone. This is a very, very interesting chart. All over the world, bearing few exceptions like Germany, incremental global growth is happening thanks to the large amount of debt which is being raised. Look at country like Spain. Debt has increased almost 4 times and GDP growth has barely moved. UK, US, Canada are in a slightly better position. But someone like France and Italy and Germany are in a far worse situation. Clearly, debt is like steroids or drugs. Once you get addicted to it, it's very difficult to move out of it. Putting all this global uncertainty in mind, investors are holding on to cash. Their investment in cash stroke liquid fund has gone up since last year, whereas in the bond market, despite higher interest rates, people have actually taken money out. And in equity, their allocation is almost at the neutral level. Effectively, people are holding on cash or short-term debt to figure out what is the right time to invest in bond, what is the right time to invest in equity. Coming to US economy, Fed has raised interest rates quite dramatically, but they haven't reduced balance sheet as much as they should have reduced. From subprime crisis till COVID crisis, they added almost 4.8 trillion worth of liquidity. What they have taken out is just $626 billion of liquidity from last year till today. Is this sufficient? Who knows? The job of Fed is complicated because despite raising interest rate at the fastest level in an accelerated basis, both US inflation headline as well as core continues to remain elevated and well above 2% target range, which Fed is comfortable with. Current inflation for headline is roughly about 6%. For core, it is little below 6, well above 2% target, which Fed has for inflation. If we apply theoretically where Fed fund should be, well, as per Taylor rule, the Fed fund should be in double digit, which is 10% plus. Despite Fed Chairman Jeremy Powell's recent comments that US interest rates will remain higher for longer and it will go far higher than expected. The current expectation is that Fed will peak out somewhere around 6%. Theoretically, it should peak out somewhere around 10%. That's the gap between Fed's expected rates by market versus what should be theoretically Fed fund rate. Why Fed cannot raise US interest rates to double digit? Well, the impact of higher interest rates have now started coming into the economy. Bankruptcies have started increasing at a rapid pace, and with little time to go, it may end up reaching subprime crisis level. The corporate earnings in US, after remaining robust to crisis, corrected in December 22 quarterly results. It has come down at almost minus 28% on a year-on-year basis. This is largest decline in earnings since second quarter 2020, which was impacted by COVID. Without the impact of COVID, this is probably one of the lowest earnings in this century. US Fed's hands are tied because their debt also is fairly large, 31 trillion total debt, and the government already runs $1.4 trillion fiscal deficit. Households are leveraged by about $17 trillion. Credit card debt is in excess of $1 trillion. Auto loans is in excess of 1.5 trillion. And students' loan is now exceeding auto loans at 1.6 trillion. Housing debt is about 12 trillion. 1% increase in interest rate means US will have to pay $310 billion in extra interest. That's a reasonably large burden on government as well as economy. With consistent rise in US Fed rate over the years, over the quarters, now earnings yield for Russell 1000 index and Fed fund rate have come closer to each other. Clearly, this is making bond far more attractive than the stocks. Before the Fed chairman's Senate hearing, market was expecting that Fed will continue to raise interest rates till mid 2023 and start cutting interest rates somewhere in end 2023. Now, both those things have been kind of pushed back by about 3 months. In that deteriorating global background, if we look at Indian economy, it is doing reasonably well. Many headlines are positive, like on an incremental basis, 15% of global growth this year will be driven by India. Services PMI climbs to 12-year high. Agri exports touch 20 billion in first 3 quarters. The Kharif crop of wheat and rice production is at all-time high. Air passengers are up. Credit card spends remains over 1 lakh crore for 11th straight month. Core sector output increased by 7.8% in Jan. And PLI scheme is also now showing good traction in terms of employment. There were some headlines which were negative. One, inflation came 6.52 ahead of RBI's target range as well as market expectation. The third quarter FY23 down to 4.4%. Manufacturing PMI declined marginally. And most importantly for us, there is risk to normal monsoon thanks to developing El Nino. It's too early to say what will be the total impact on monsoon, but certainly it's a cause of concern at this point of time. If we look at third quarter FY23 GDP, growth came at 4.4% because last year the base was reasonably high. Within that, services went up at 9.7%, construction at 8.4%, and power demand at 8.2%. Capital formation at 8.3% was also satisfactory. But the real challenge for us was in manufacturing, which recorded negative growth of minus 1.1%, government spending, which was just up 2%, and consumption, which was up only 2%. In this dark clouds, silver lining was revision in last 2 years GDP growth, FY21 minus 6.6 to minus 5.7, and FY22 8.7 to 9.1. It effectively meant that last 2 years we underestimated actual GDP growth, and real GDP growth has come ahead of initial estimates. If we look at Indian economy, domestic activities are now near all-time high and capacity utilization is above long-term average. PMI remains in expansionary mode. Services PMI hit a 12-year high, whereas manufacturing PMI declined marginally. GST collection has been remaining above 1,40,000 crore. And tax collection growth is now running almost near 20%. Credit growth is now moving into double digit. Non-food credit growth is healthy at 15.3%. Industrial credit growth is running at almost 14%. And personal loans is running at almost 26%. Agri growth continues to surprise on the upside. However, if monsoon is not good, thanks to El Nino, then this could cause a negative surprise. Normally, ahead of election, government spends money on building infrastructure. We have seen that playing out in various cycles like 2014, 2019. Hopefully, 2023 infrastructure spending will be well ahead of what we have seen between 21 and 22. Private sector investment has started improving as capacity utilization is above long-term average. The government has increased allocation to infrastructure. Private investment is picking up. This is pushing overall investments into higher territory. We talked about PLI scheme and how China plus one is happening. 14% of all the 135 companies which shifted out of China for better opportunities have come to India. They are coming to India for automobiles, for electronics and electronic components, for toys, and all those kind of industry. The government capital expenditure is expected to go up by 20% plus in FY24. And thanks to election, a majority of this will be spent in completing or in doing faster execution of infra projects. Employment data remains robust. Inflation for FY24 is likely to remain below RBI's target range of 6%. People are expecting inflation to be somewhere hovering around 5.5%. Within inflation, the large driver was coming from food inflation, and especially if monsoon gets adversely impacted by El Nino, then food inflation can spike up and again cause headline inflation to go higher. For us, oil prices coming down is a blessing in disguise. From triple digit, oil has come down to double digit. As long as oil remains around this level, our economy will do well. We had mentioned in the past that India's trade deficit continues to remain well ahead of our comfort level. There was silver lining in the dark cloud. The trade deficit for January came at a much comfortable level of $18 billion, where thanks to imports contraction, trade deficit declined from $25-30 billion a month to $18 billion. For us, the weakness continues to remain in consumption. Many of the listed FMCG companies showed either low volume growth or negative volume growth in the December 22 quarterly results. This is a cause of worry for Indian economy as volume growth remains muted on the consumption side. This volume degrowth is driven by rural economy, where rural FMCG for last 5 quarters is witnessing negative volume growth. In urban market, the reversal has occurred in last 3 quarters. Obviously, what has happened in urban market in terms of recovery in FMCG volume needs to be replicated in rural market. The other way to look at consumption, it remains well below pre-pandemic trend. If we take a straight line ahead based on pre-pandemic consumption curve versus actual consumption post-pandemic, then clearly there is a big gap which we need to fulfill by supporting consumption. The other way to look at slowing consumption is that credit card spend has increased, but debit card spend has actually decreased. Normally, credit card is given to people who are rich and whose credit is beyond doubt. Debit card is used by people who have bank account but who does not have access to credit facility. If these people are not spending as before, it means consumption at their level is adversely impacted. Put all these things together, India has many bright spots and few causes of concern like consumption trend. However, investors believe India will differentiate itself on 3G growth. Our earnings growth will be superior to our peers. Our governance standards will be better than our peers. and we will take care of environment and social standards better than our peers. As long as India delivers on this 3G, foreign investors will continue to invest in India. This is an interesting chart. In this century, that is 2000 to 2022, only two countries, China and India, has increased their GDP relative to US. Every other country, Japan's GDP has come down, so has Germany, so is UK, France, and Italy. Only two economies whose GDP has expanded in 2022 relative to American GDP in 2000 is China, which has done a big leap, and India, which has done a smaller jump. However, India now seems to be reaching sweet spot where our share in global GDP is set to expand from 3.5% to 4% over next couple of years. Coming to the debt market, US inflation continues to remain high. That is pushing Fed to become more aggressive. And the recent testimony of Fed Chairman Jeremy Powell in US Senate indicates a more hawkish Fed, which is likely to raise interest rates more than expected by the market. The 10-year US yield, after declining from 4%, is now back to 4% plus. The movement in US Treasury yield is more profound at the short end of the curve, but across the board, there is increase in US Treasury yields. India, in terms of real interest rates, continue to remain positively placed vis-a-vis US. US real interest rates are negative. Our real interest rates are positive. And the gap between US versus Indian real interest rate today is one of the widest. RBI has done a fantastic job in managing local debt market. They have taken away excess liquidity buildup over years in a calibrated manner from roughly about 8 lakh odd crore liquidity in May 22. Now liquidity has come down to as low as probably 50-60,000 crore. In this scenario, the 3 to 7 year segment for maturity looks appropriately priced. It will not get hit if interest rate continues to rise. It will not participate if interest rate falls. This is one part of the curve where risk and reward seems to be properly placed. Though there is not much increase in last year's borrowing program and this year's borrowing program, the big differentiator is the liquidity. Liquidity was hugely available during FY23. FY24 may not be that lucky, and hence RBI support will be needed to ensure that massive borrowing program of the government, 11 trillion rupee plus, gets executed efficiently. The yields continue to harden across government securities, corporate and state development loans between last year and this year. The 1 year yield was roughly about 6%. Today, it is 722. The 10-year yield was about 742, and it is now at 743. There's not much movement on a 10-year basis, on a 1 year basis, but at the shorter end, movement is more than 125 basis point. In terms of debt investments, one can look at Kotak Gilt Fund, its sovereign portfolio, so no credit risk. 50% of portfolio is floating rate bond exposure, so well poised for current interest rate volatility. And Deepak Agarwal and Abhishek Bisson manages duration quite actively to generate better return. Kotak Dynamic Bond Fund continues to outperform its benchmark index over last couple of years. This fund has done reasonably well across interest rate cycle. We will also recommend, especially at this stage, investment in active strategy fund rather than passive roll down strategy fund. We believe in today's environment of falling interest rates, after a while will create better opportunity for investment in active strategy. State development loans continue to give higher spread vis-a-vis government securities. So do consider state development loan funds as part of your portfolio. There are many debt funds in our stable which has now started giving more than 8% return on a yield basis. In medium-term fund, yield is as high as 8.4%, despite having 61% of portfolio in sovereign and AAA and keeping modified duration at a moderate 3 years. There are many such funds within our stable where gross yield is now in excess of 8%. We have been recommending hybrid funds for debt investors between Kotak Debt Hybrid Scheme, Kotak Equity Saving Scheme, or Kotak Equity Hybrid Fund. These funds have consistent track record of super performance, of double-digit performance over last 3, 5, and 7-year basis. They add alpha over benchmark indices, and they will be good fit into conservative investors' portfolio. Coming to equity markets, we continue to trade at a significant premium to our own peer group. We are 3 times more expensive than Brazil. We are about 1.5 times more expensive than China and South Africa. This has resulted into short-term investors booking their profit and moving into cheaper markets. China, because of its size, has received maximum flows despite very, very unsatisfactory performance. On the other hand, emerging market Asia hasn't received as much flow as whole of China has received. As of today, we believe the growth differential now favors emerging market. Emerging markets will do better than US and developed world in terms of growth rate. If we compare India vis-a-vis its peer, we come out in top quartile of ranking. Our valuation premium versus rest of the peer group has come down, but it is still well above our historical average of about 79% versus where we are trading right now at 122% premium. The domestic institutional investors like mutual funds, thanks to all of you, continues to play an important role. At one point of time, the FPIs were overpowering domestic investors, and their buying and selling used to dictate direction of the market. In the last couple of years, especially since March 20, domestic institutional investors have played very, very serious role. They have bought when markets are down. They have booked profit when markets are higher, and their participation has created an alternative to FPI flows. If we look at from a valuation point of view, we continue to trade at or around our historical average. Historical PE is about 18.4 times. Currently, we are at 17.7 times. We believe earnings will be revised downwards, and we might be trading somewhere around 18.5 times 1 year forward based on downgraded earnings. On a price to book, we continue to trade at a marginal premium to long-term average of 2.6 times. Market cap to GDP ratio at 95% is above historical average of about 79%, but it is significantly lower than 112%, which it had reached last year. The December 22 quarterly results were kind of mixed. In the banking and financial services, results were well above expectations, but rest of the sectors, results were little below expectations. The earning per share forecast of Nifty 50 has revised modest cuts. We believe for 2025, the EPS of Nifty could be anywhere between 1070 to 1074 per Nifty share. This is a very, very interesting chart. We read transcripts of various companies in NSE 500. 386 companies talked about macro environment in their conference call, and 299 talked about slowdown in their businesses. 84 companies complained of margin compression, and 59 companies talk about capex growth, which is likely to support growth in the days to come. Clearly, on one side, corporates are worried because of macro situation and slowdown enforced and margin compression, but at the same time, they continue to remain bullish for investment in capital expenditure. It will be fair to say that next year will be full of volatility. Without sitting in roller coaster, we are likely to get that experience. Our call remains unchanged. This is time to be neutral weight equities. In large cap, be marginal overweight. Small and mid cap, be marginally underweight. Most importantly, use correction as an opportunity to increase allocation to equity. Don't chase the momentum, but try to stay invested. And whenever correction comes, use as an opportunity to increase your equity allocation. If we look at our performance, clearly, please remember that even God can underperform the market. This is 10-year alpha of Berkshire Hathaway over S&P 500. There were periods where God outperformed S&P 500 by big margin. There was period where Warren Buffett and Charlie Munger were generating outperformance by a smaller margin. And for over last 10 years, Berkshire Hathaway has underperformed S&P 500 total return. It just shows to prove that fund managers are also human and they can't guarantee performance year after year, day after day, month after month. It is immense pride to me that I'm presenting these slides. The whole media last year was talking about how fund managers were not generating alpha. At that point of time, also we were generating alpha, but not as good as you are seeing today. Thanks to correction in certain stocks which were part of index, but not in our portfolio, our alphas have become even better. A Kotak small cap fund has alpha of almost 14% for a 5-year basis. Since inception, it is generating 9% alpha. Even large cap fund like Blue Chip has now 1% alpha since inception over large cap indices like Nifty. Clearly, our fund managers are doing their job and are adding value to your customer. The same thing is there in hybrid category. All our funds have generated positive value add to our customers across almost all periods. Our SIP alpha generation is equally commendable. We have given double-digit, mid-single-digit, low-single-digit value add to our customers across SIP format. If we look at our hybrid funds SIP, they also have generated alpha for our investors. The rabbit and tortoise fund, where while going up, funds gives higher participation, and while coming down, fund gives lower participation. We have been able to achieve across our debt hybrid scheme, equity savings scheme, multi-asset allocator fund of fund, and balance advantage fund. Undoubtedly, all these funds, when market goes up, delivers higher participation than average equity holding, and when market goes down, gives lower participation than average equity holding. the ratio of upside to downside remains in between 2 to 4 times. Kotak Manufacture in India Fund, which my colleague Harish Krishnan manages, it has generated an alpha of almost 6% over last 1 year. While markets are more or less flat, index has delivered double-digit return, generating value add of more than 6% over last 1 year. Kotak Infrastructure and Economic Reforms Fund, which also is managed by Harish Krishnan, now has generated alpha over 1, 3, 5 and 7-year basis. Kotak FlexiCap Fund is the largest equity fund in the industry. It did hit a purple patch in between, but it has strongly bounced back despite its large size. And my equity CIO, Harsha Upadhyay, continues to manage this fund for a long, long period of time with great success and great aplomb. Kotak Tech Saver Fund again has generated alpha for investors over last 1, 3, 5 and 7-year basis. In this tech season, this is one of the best way to earn return as well as earn tax savings. Multi-asset allocator fund of fund remains fill it, shut it, forget it kind of fund. It has grown 1 lakh into 15 lakhs over last 19 years of operation. In last 10 years also, money has grown almost 4 times. Coming to gold as an asset class, central bankers are buying gold in a dramatic manner. Last week, Singapore central bank bought gold. Chinese central bank also is buying gold. I met someone today morning who said that China's gold vault in Beijing is fully packed, and now they have opened another gold vault in Wuhan to buy and store gold. In his opinion, China, which has about 2,000 tons of gold at this point of time, is looking to overtake US, which is having the largest gold holding by any central bank in the world at about 9,000 tons. If China, Singapore, and other countries' central bank continues to buy gold, learning from the experience of Russian central bank, undoubtedly gold prices will move on the higher side. Whenever Fed rate starts coming down, gold prices get supported. In last cycle, somewhere in 2019-20, when Fed rate started coming down, gold prices delivered 153% return. The only risk for investment in gold is import duty, which is right now at about 15% plus. What you buy for $100 in Dubai or Singapore, you will be paying 115 in India. And to that extent, you get lower quantity of gold despite paying higher money.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.